If you think California real estate only goes up in price, you're making a costly mistake. Why have cities that were once investment paradises now turned into financial nightmares? Why are hundreds of luxury mansions sitting unsold, even after price cuts of hundreds of thousands of dollars? In this video, you'll discover the 10 fastest free-falling markets in California, and you might even be living in one of them without realizing it. I challenge you to guess 3 names in the top 5 before being completely surprised by the number 1 spot. Untitled Sacramento, the cheap trap, tightening around investors and residents. You think buying a cheap house is lucky? In Sacramento, it could be the biggest mistake you ever make. Because once you buy in, the chance of being stuck in a market with low liquidity, high interest rates, unable to rent, unable to sell, is very real. This was once the promised land after COVID, where people from the Bay Area flocked to find affordability, more space, and comfort. But from 2023 to mid-2025, Sacramento has flipped. The median home price has dropped to about $407,000, down nearly 2.6% from the same time last year. But what's scarier is even with prices falling, there are still no buyers. Want to sell your home? Get ready to wait an average of 26 days, 1.5 times longer than last year. And even after that time, you may still have to cut prices deeply just to get out. Residents here describe it perfectly. Many homes are sitting on the market, waiting for price cuts. And if you think buying to rent will be the solution, the bad news is the rental market is also stalling. Average rents dropped 6.5% in 2023 with no signs of recovery. The inflow of people from the Bay Area has stopped. Net migration fell to 0% by the end of 2024, meaning no population growth, leading to much weaker rental demand. For older investors, this means it's very hard to find long-term tenants, even if you already have a house. Interest rates and insurance, 2 never-ending nightmares. If you're financing a home purchase, interest rates have climbed to about 7%, double the 2021 level. Borrowing costs are 1.5 times higher, but wages haven't increased. In fact, they've been cut as businesses tighten spending. Worse, homeowners' insurance is soaring, especially in wildfire risk zones, and property taxes at an average of 1% per year don't fall when home prices fall. You're still paying based on the previous, higher assessed values. A painful paradox. Sacramento, even as the state capital, has no major industries beyond government administration and services. No tech. No large-scale manufacturing, no new investment capital. Jobs may be stable, but there's no income growth. Meanwhile, Bay Area tech companies are requiring employees to return to the office, stripping away the main reason thousands moved to Sacramento during the COVID era. Finally, the factor few dare to say out loud: crime rates are rising. Infrastructure is not keeping up with the pace of urbanization, making Sacramento no longer attractive for those who want to settle long-term. The combination of all these factors, falling prices, weak demand, high ownership costs, economic risks, and difficulty selling, has turned Sacramento from a safe haven into a true trap for anyone who thought this was the ideal place to buy. Easy to buy, hard to sell, can't rent. Burdens keep piling up. Sacramento is no longer the story of the American dream. It is an expensive lesson about the mistake of putting faith in artificial growth. Are you considering investing in Sacramento? Don't rush. Share your thoughts in the comments below, and keep watching to see if the next cities are truly the places you want to buy. 9. Riverside, from promised land to frozen ground. In mid-June 2025, a shocking statistic appeared on Redfin housing inventory. In Riverside hit nearly 14,000 units, the highest in the past 5 years. A market that once was so hot that homes were snapped up the moment they were listed has now fallen into a prolonged, deep freeze, with sellers cutting prices again and again while buyers quietly walk away. The fever has broken. And what's even scarier is this: no one is rushing to buy anymore. Home prices in the Inland Empire rose only 1.1% year over year in 2025, a pale number compared to the peak of plus 122.7% in 2022. Meanwhile, 25% of listings were forced to cut prices, and inventory surged nearly 88% compared to last year. This is not just a pause. It is a signal of a silent exodus, as sellers race to unload while buyers hesitate to catch a falling knife. Riverside was once the promised land. But now, a gamble with an increasingly high chance of loss. In terms of transactions, the cold market means homes here are selling slower than ever. Home sales in 2025 dropped 16.5% compared to the pre-pandemic period. Not only young buyers but also older homeowners are pessimistic. No one's renting, no one's buying back. They worry as they watch their assets turn into burdens that generate no income. The rental market is also collapsing. Domestic migration has fallen to 0%. No more inflow of people from expensive cities like LA or OC. Rental demand is weak, rents are flat or falling, and many apartments far from the center sit vacant for months. Those who once lived off rental income are now struggling to find stable tenants. The headwinds from the macro economy are blowing harder. High interest rates, combined with expensive taxes and insurance, are eroding purchasing power. This situation is especially severe in Riverside, where median income is only 70% of nearby major metros. Industries that make up a large share, like logistics, retail, and construction, are fragile and now even more vulnerable as the economy stalls. By July 2025, jobs in the area showed no increase compared to the same period last year, a clear sign the economic engine is stalling. The familiar picture: homes with discounts, price cuts, for sale signs hanging for weeks, yet still no one is looking. Another burden: the long commute. Losing 1 to 2 hours each day traveling to Los Angeles or Orange County. As companies call employees back to the office, life in far-off areas like the Inland Empire has lost its appeal. Gas money, time, exhaustion, all of it makes many people reconsider staying. Many who bought at the 2021 peak are now stuck. Some say they've had their homes listed for weeks with no buyers, and asking prices are even lower than their current loans. A resident in South Sacramento said, "We bought our home for $530,000, and now even at $480,000 no one is interested." From a symbol of post-pandemic recovery, Riverside has now become a living warning about the risks of false expectations. The market is no longer hot, it is freezing by the day, and those who stay may end up bearing the heaviest consequences. What do you think of this outlook? Share your thoughts, and don't miss city number 8, where the frenzy just ended. But the aftershocks are still rumbling. 8. Bakersfield. Is this where investors are quietly making their exit? Once called the last affordable capital of California, Bakersfield is now seeing a wave of sell-offs, price cuts, and widespread stagnation. The big question is, Bakersfield sliding because of the broader market, or because its very model of growth was too fragile from the start? By mid-2025, the median home price in Bakersfield had dropped to just $405,000, down more than 3.6% year over year, and 10–15% below its 2022 peak, a steeper decline than many other parts of California. But what's more troubling is this: even with falling prices, no one is buying. The average listing time has stretched to 34 days, and over 26% of listings have been forced to cut prices. In investment-heavy areas, especially homes once marketed as Airbnbs, Many have sat for months without a single inquiry. That silence isn't just the sound of a cooling market. It's the echo of confidence draining away. In 2021-2022, Bakersfield was a magnet for flippers and Airbnb investors. They bought in expecting easy vacation rentals or quick resale profits. But harsh reality quickly set in. Bakersfield is not a tourist destination. Airbnb demand is weak. Short-term rental interest is virtually non-existent. Renovated properties built for visitors now sit empty, unsold, unrented. Some investors are burning cash to cover mortgage payments and maintenance on vacant homes, or pivoting to long-term rentals at lower than expected rates, and still struggling to find tenants. The rental market here is bloated with supply and starved of demand. Population growth is slow, incomes are low, jobs are unstable. As unsold homes flood the rental market, supply spikes. Meanwhile, former Airbnb units add to the competition. Homes far from the center or with poor amenities are hardest to fill. And for retirees hoping this could be a haven, Bakersfield falls short, with healthcare and public services stuck at a middling level. One Airbnb host in Bakersfield shared, "I used to make $3,000 a month from short-term guests. Now the house sits empty for an entire month. And even after switching to long-term rental, there's still no interest." This is the common picture, as the Airbnb model faces double pressure, falling demand, rising costs, and tightening regulations. The burden of expenses is tightening like a vice on Bakersfield homeowners. Mortgage rates have doubled over the past 2 years, making it impossible for average income residents, who make up the majority here, to buy. Home insurance in California continues to rise, driven by wildfires and floods across the state, even though Bakersfield is less affected. Meanwhile, property taxes remain high and don't fall in line with prices, meaning new buyers pay steep taxes on a depreciating asset, a bitter paradox. At the core of all these risks, Bakersfield's economy is heavily dependent on oil and agriculture. When oil rises, the city thrives. When oil falls, everything sinks with it. With policies shifting toward green energy, coupled with volatile oil prices, layoffs in the oil industry are no longer rare. Each shock in oil prices ripples through housing. People lose jobs, move away, homes sit empty, prices drop again. Agriculture is also struggling due to prolonged drought. Average income here is only about $65,000 a year, and unemployment remains higher than the state average. What do you think about those Airbnb investors now trapped in Bakersfield? Is it time to be more cautious with these so-called affordable markets? Share your thoughts, and stay tuned for City Number 7, where a seemingly safe haven is cracking day by day. 7 Fresno. When the boom turns into a haunting ghost. Do you remember the last time you looked at a home price tag and asked yourself, did I buy too early? Or did the market collapse right after? Fresno is the embodiment of that regret. Fresno used to be the land for those escaping the insane Bay Area prices. Home values skyrocketed during the pandemic. Then, from the 2022 peak, began a free fall. According to local data, Fresno real estate has lost 10 to 20% of its value from the 2022 peak, depending on the area. Home sales in 2024 dropped 31%, the lowest since 2011. The market is drained of liquidity for the third consecutive year. Home sales declined. Even though early 2025 showed a slight uptick, the overall picture remains bleak. Many suburban areas have newly built homes with no buyers. Residents saying houses are finished, but look abandoned. The average days on market in Fresno consistently exceeds 1 month. Many listings sit 34 to 40 days without inquiries, forcing homeowners to choose between cutting prices deeply or waiting endlessly. Older families who bought at the peak are now forced to accept losses if they want to leave the area. Falling prices, plus high mortgage rates, plus rising living costs. Large monthly payments, declining asset value, and few exit options. The rental market in Fresno is somewhat more stable, not crashing like the sales market, but not booming either. Rent increases only around 2 to 3% per year, with vacancy rates at about 4 to 5%, a level considered normal, even slightly high. New apartment supply has dropped sharply. In 2024, only about 600 units entered the market, significantly lower than before, as developers worry about oversupply and tenants' ability to pay. Mortgage rates have jumped from the pandemic-era lows to around 7% or higher, cutting affordability for many buyers. Fresno, located inland and less exposed to wildfire risks than forested areas, has not seen insurance costs spike dramatically. Yet it still suffers from the broader trend: insurance premiums and property taxes rising based on past purchase prices, plus higher utilities and local taxes driven by inflation. For many older residents living on fixed retirement income, these rising costs are a real financial burden. Falling prices, poor liquidity, rising ownership costs, and a shaky economy. For middle-aged or older buyers, Fresno is no longer the cheap and safe option. It has become a gamble loaded with risks. 6. Stockton. History repeats. Are we watching 2008? All over again. One afternoon in early 2025, a local headline read, "Stockton continues to record the highest number of foreclosures in the past 18 months. The echoes of the past are loud. Stockton seems to be reliving the dark chapter of the 2008 housing crash." Stockton was once a hotspot in California's housing market. Affordable homes, Bay Area migrants fueling demand, prices pushed higher. But since late 2022, the market has been in decline as mortgage rates climbed. By mid-2025, the median home price sits around $430,000, down roughly 7.9% year over year, one of the sharpest drops in the state. Average days on market rose from 23 to 32 days, a clear signal of excess supply and waning buyer urgency. Home sales in July 2025 reached only 157 units, down from 168 the year before. Many recent buyers, especially those who purchased for investment or rentals, now admit they bought only to realize they can neither rent it out nor sell it. They're trapped with debt, paying mortgages higher than achievable income, as high interest rates and falling home values leave them stuck with assets they can't unload when relocation or a quick sale is needed. Stockton is not only in a price crisis. Crime and infrastructure are the onion layers driving many people to leave. Recovering from the city's 2012 bankruptcy, Stockton once cut its police force by a third, leaving public services weak. Today, infrastructure is deteriorating: streetlights, roads, public spaces, even traffic safety, all declining in quality. Older residents worry living in a place with poor safety, far from hospitals, and weak amenities directly impacts their quality of life. High interest rates tie down Stockton more than most, because the majority of buyers are locals with lower than average incomes, paying high mortgage interest plus high property taxes. Rising insurance premiums all weigh heavily on homeowners, especially older people who want to sell and relocate or retire. On top of that, Stockton's proximity to the Bay Area comes with a long commute. As remote work demand falls, people no longer want to live where they must drive 60 or 70 miles each day. Looking ahead, Stockton has little support. Its economy depends on agriculture, logistics, and local services, with no new tech industry or major investment flows. If the national or global economy weakens, Stockton will feel it hard. Unemployment may rise, foreclosures may spike again, and home prices could be forced down further just to attract buyers. Did you once think Fresno or Stockton were safe bets? Share your thoughts in the comments, and don't forget to hit like and subscribe so you don't miss the next analysis. 5. Modesto. From housing boom to freefall, Modesto was once the affordable destination for people leaving the Bay Area during 2020 to 2022, pushing home prices up more than 20% per year. But after the frenzy, Modesto's market has plunged. The median price now hovers around $442,500, down about 3% year over year. Transactions have dropped sharply, many owners are holding on to properties they can't sell, and the market has shifted entirely from a seller's market to a buyer's market. What's more concerning is that Modesto's economy relies mainly on agriculture and food processing, sectors highly sensitive to cost fluctuations and droughts. When fertilizer and fuel prices surged in 2022-2023, farmers' profits fell sharply, dragging down housing demand. Household income, $68,000, is below the level needed to afford a $440K home at a 7% interest rate, leaving many past buyers struggling with mortgage payments. Some families have been forced to sell at a loss or are stuck with debt larger than their home's value. The rental market in Modesto is no longer attractive either. Many young people are leaving due to a lack of good jobs, while those from the Bay Area hesitate to return because of long commutes. Rents have stagnated. Supply has increased as many listings shifted from sale to rental, and yields have dropped, leaving cash flow too weak to attract investors. 4. Palm Springs. From retirement paradise to financial trap, Palm Springs was once considered the ideal oasis for retirement and Airbnb investments in California, with sunny villas and a relaxed lifestyle. However, since 2022, the vacation home market here has reversed sharply. Average days on market have stretched to 92, with many high-end homes sitting unsold for an entire year. Even though the median price remains high, $650K, many actual transactions require deep discounts to close. The main reason comes from Palm Springs' tightening Airbnb regulations. License caps, higher taxes, and heavy fines for violations have cut off many homeowners' main source of income. Properties that once generated steady cash flow have turned into cost burdens. At the same time, tourism has slowed due to economic uncertainty, making short-term rental investments far less effective. In addition, the harsh desert climate has driven maintenance and air conditioning costs soaring, especially during peak summer heat. Some areas also suffer from sandstorms and flash floods, further raising insurance premiums. With an economy almost entirely dependent on tourism and retirees, Palm Springs lacks resilience in the event of a tourism downturn, leaving many investors now reconsidering whether to hold or cut losses. Are you considering investing in a vacation home? Hit like and subscribe so you don't miss the next analysis. 3. Oxnard. Beautiful beaches, clear skies, but debt in every grain of sand. Have you ever dreamed of waking up to see the ocean right outside your bedroom? Oxnard once gave you that feeling. Golden sunrise on the sand, waves crashing, salty sea air. But behind that beauty is the fear of home prices being squeezed. The median home price in Oxnard has reached around $740,000, a figure that forces locals to count every penny if they want to dream of buying. And as interest rates climb, and as maintenance, taxes, and insurance costs all rise, out-of-state buyers hesitate to return. Luxury beachfront homes, villas, upscale condos sit on the market for months. Some neighborhoods have already dropped 20–30% from peak frenzy levels. Liquidity, once a feast, has now turned into a contest of who's willing to slash prices deeper. What about rentals? Previously, Oxnard expected Airbnb and vacation rentals to be the lifeline, but the flood of tourists has slowed. Long-term tenants are fragile, retirees, commuters seeking stability. Yet high rents plus high living costs defeat most of them. Many homeowners admit the house no longer brings profit, forcing them to treat it like a suspended asset, carrying the costs while waiting and hoping for prices to recover. If you're thinking Oxnard is the place to retire, ask yourself how long can you afford to wait to sell at a price that covers the cost of living, insurance, taxes, and amenities? The ocean may be beautiful, but if your house has no buyer, it's just a pile of memories and a burden of expenses. Do you want to know where the next safe place to invest is? Hit subscribe now. The market is changing every day. Fairfield. Between two big cities, but can't grow itself. Fairfield may sound like it's in a perfect spot, between San Francisco and Sacramento. But the truth is it's being drained dry because being in between doesn't mean it gets the advantage. By day, you might think great location. Just about 45 miles to SF, 45 miles to Sacramento. But the daily grind of driving on I-80, traffic jams, accidents, hours wasted in the car, is enough to make you want to give up after a few tries. With remote work declining, people no longer want to pay the price in time and fuel. Homes are built fast, streets expanded, ads shouting half the price of the Bay Area. But then what? Many new builds sit empty. Inventories pile up. Prices have to be cut just to lure buyers. Median prices are slipping. Selling times stretch to nearly 50 days, and many homes only move after deep discounts. Older buyers, especially those who bought during the low-interest era, now face a shock: higher rates, rising taxes, plus maintenance, plus utilities. If they sell, they take a loss. If they hold, the monthly costs soar. And if you're older, planning to move or retire, Fairfield may be a trap more than the safe haven you thought. Where's Santa Rosa? When the wine country paradise turns into a financial trap. Santa Rosa used to be a dream address for the well-off. Hillside villas, $2 to $5 million, were once chased after. But today, rows of luxury homes sit unsold, some listed for months with no inquiries. The average selling time has climbed to about 48 days, and the high-end segment takes even longer. Median prices have only slipped 1–2% year-wide, but in reality, luxury homes have dropped 10% or more if the owner wants a quick sale. The biggest threat: wildfires and insurance. Santa Rosa has endured devastating fires, painful and destructive. Homes on the hillsides, those near the forest. Insurance has either skyrocketed, been denied outright, or required extremely high premiums to secure coverage. For older residents, retirees living on fixed incomes, hearing that their insurance policy was canceled feels like a thunderbolt from a clear sky. Santa Rosa continued. In addition, the local economy depends on wine tourism, hospitality, retail, and healthcare. When the climate shifts, when wildfires strike, when tourists avoid the smoke, people skip Santa Rosa. Ordinary incomes cannot keep up with the rising cost of living. Property taxes, utilities, maintenance, all are increasing. Seniors fear they may have to sell their homes if the costs become unbearable. But will there be anyone willing to buy? 10 cities, 10 wake-up calls. Real estate is not always a gold mine. Some places that were once dreams have now become burdens. Some places that seemed cheap to invest in turn out to be liquidity traps. If you're considering buying into California, truly understand the market. Don't get swept up in the hype wave. A hasty decision today could be the price you pay for years to come. Which city impressed you the most? Don't forget to like and subscribe so you won't miss the next in-depth analysis.